Hello, my name is Ray Franklin. I'm the Senior Commodity Analyst for Energy Professionals. Today's video is a summary of my July 29th Energy Update, in which I'm going to explain why we may not only be in the early stages of a cyclical bull market, but also a secular bull market. I focus on natural gas in my videos because it is the largest source of power for the generation of electricity. Therefore, their pricing is highly correlated. In our July 22nd Energy Update, we explained why we believe the latest short-term decline in natural gas was a long-term buying opportunity based on the empirical observations in the following chart. As you can see in this chart, since 2000, when natural gas declined to where it is in 2024, it always preceded cyclical bull markets that trended higher for at least 2 to 3 years. But as I said earlier, we may not only be in the early stages of a cyclical bull market, but also a secular bull market. This chart shows secular and cyclical markets over the last 25 years. When planning your long-term energy strategies, it is important to know the difference between the two. Cyclical energy markets last a few years, while secular energy markets are longer, lasting many years, and often include multiple cyclical markets. In today's report, I will explain what led to the two previous secular markets, one a bull and one a bear, and why we may be in the early stages of a second secular bull market. In this chart, you can see the first secular natural gas market was a bull market from 1999 to 2009, which included 4 cyclical bull markets shown in the first green square box. During those 10 years, natural gas couldn't respond quickly to increased demand caused by hot summers or cold winters, or during the summer storm season, when hurricanes often disrupt production, resulting in lower supplies. This was the major influence leading to a secular bull market characterized by high volatility. This period was followed by a second secular natural gas market, a bear market from 2010 to 2020, shown in the second red rectangle, which included 3 cyclical bear markets. Fracking was introduced during this period, enabling the production of natural gas to be more efficient, which resulted in America being blessed with sufficient supplies to meet our energy needs over the next 10 years. This led to a secular bear market characterized by lower volatility. But this all changed in 2021, when a war on fossil fuels was instituted in America while embracing green energy policies. The consequences of these two policies is the production of natural gas is now being restrained, which may lead to a second secular bull market characterized by high volatility. In our July 22nd Energy Update, we said our approach for analyzing the natural gas market is to use the empirical evidence derived from past price patterns to guide our recommendations, and then explain why the patterns formed. As you can see in this chart, going back 25 years, 2 very similar patterns were formed in 2002 and 2024, and they're circled in red. And as you can see, in the next 2 charts, both patterns were formed after explosive cyclical bull markets, which followed a relatively calm period. In both instances, after calm periods, both markets experienced explosive rallies from below $2 to $10 per million BTU. And both markets then retraced all of their gains, trading back below $2 per million BTU. Why did natural gas experience wild price swings in 2002 and this year in 2024? As I explained earlier, the natural gas market entered a secular bull market from 1999 to 2009, which was characterized by high volatility. Wild swings from spike highs to unsustainably low lows are classic price patterns during secular bull markets. The pullbacks are useful tools for large traders to lock in profits accrued during the spike highs, while helping them to again enter new positions at very attractive price levels for the next move higher. Are there any other similarities between the explosive rally in 2002 and a potential explosive rally now in 2024? Yes. Just before the rally in 2002, Baker Hughes reported year-over-year active gas rigs were down 19%, and in their last report on July 26th, Baker Hughes is reporting that this year active rigs are down 21% year-over-year. In both instances, producers responded to the unsustainably low prices below the cost of production by cutting production to support higher prices long-term. Therefore, we believe the risk of natural gas experiencing an explosive rally very similar to 2002 this year is very high, and recommend anyone with agreements expiring over the next 18 months take advantage of the recent decline to lock in rates lower than where they are expected to be at least through 2025. At the beginning of this report, I promised to explain why we may be in the early stages of a cyclical bull market, but also an early stage of a secular bull market. We believe the risk of a second secular bull market is increasing due to the war on fossil fuels and green energy policies discussed earlier, and they're gaining traction throughout the world. The ramifications of these policies are higher energy prices and price volatility here and abroad. The silver lining for America's fossil fuel industry is we have become the largest exporter of liquefied natural gas, that's LNG, overseas and exports to Mexico via pipeline growth, which benefits their profit margins. The Energy Information Administration, EIA, forecasted America's liquefied natural gas, that's the LNG, exports will continue their growth since 2016, with 3 LNG export projects presently under construction, beginning operations and ramping up to full production by the end of 2025. The EIA also forecasted another factor that will support the growth of America's natural gas exports, our continued pipeline growth mainly to Mexico. The byproduct of the continued growth in America's exports is the EIA predicts America's net exports of natural gas, which would be exports minus imports, will grow 6% to 13.6 billion cubic feet per day in 2024, compared to 12.8 billion cubic feet per day in 2023. And in 2025, the EIA predicts net exports will increase an additional 20%, going to 16.4 billion cubic feet a day. The continued growth in America's exports benefits the bottom line of our energy companies, but it will adversely impact America's consumers as the growth in exports is decreasing our domestic supplies, which will support higher domestic prices long term. It is important to note green energy policies embraced throughout the world are showing no signs of abating. Therefore, America plans on continuing to build more facilities to increase our capability to meet long-term energy needs overseas and in Mexico. Natural gas is still by far the largest source of power for the generation of electricity in America, and will remain so for at least the next 5 to 10 years. The world's dependence on America's exporting natural gas will draw away supplies for our domestic use and keep prices higher here at home. Therefore, these facts will not be impacted by which party controls the White House in 2025. Either way, the present price of natural gas is below the cost of production, and producers will be forced to cut production, and our exports of natural gas will continue to increase for the foreseeable future. Based on these facts, the risk of our entering a second cyclical bull market within an ongoing secular bull market is increasing. Therefore, we recommend securing long-term agreements when your present agreements expire. Those who did so in 2002 avoided the pain of higher prices and extreme volatility over the following 7 years. We realize our clients' risks, tolerance, and hedging strategies are not all the same, but hopefully today's report will help put into perspective your risk-reward opportunities. And we invite you to call one of our energy analysts to help you plan a hedging strategy that would be appropriate for your situation. And until my next report, please take care.